Major funding for these broadcasts is made possible by grants from Chase Commercial Term Lending and New York Community Bank, M&T Bank, Perfect Building Maintenance, Capital One Bank, the Wyckoff Group, Greenberg Traurig. Additional funding is provided by grants from AKA Hotels, Corman Communities, Aerial Property Advisors, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Colliers International NYC, CPEX Real Estate Services, Cushman & Wakefield, Customers Bank, DDG, Dime Savings Bank of Williamsburg, Douglaston Development Levine Builders, Fisher Brothers, First Nationwide Title Agency, Flushing Bank, Foley & Lardner, Friedman LLP, Gemini Real Estate Advisors, HAP Investment Developers, Herrick Feinstein, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Chairman USRealty.com, John Katsimatidis, Red Apple Group, Kilroy Architectural Windows, New York's Window Company, Madison Realty Capital, Massey Knuckle Realty Services, Matone Group, Mercantile Commerce Bank, Meridian Capital Group, Newmark Grubb Knight Frank, New Banks, MHP Real Estate Services, People's United Bank, SJP Properties, Sterling National Bank, Sterling & Sterling, Stonehenge Partners, TD Bank, Terra CRG, The Continuum Company, CUNY TV Foundation, the Moynihan Group, Urban American, and These Friends.
For a city with close to 9 million people, 56 million visitors, there are a lot of banks, or there are a lot of banking institutions who want to do business with everybody who does business in New York. So today I've assembled this group of individuals or bank executives to provide their insight on banking in New York, new entrants in New York, and how they see the economy at the beginning of my 14th season of the Stoll Report. My guests today include Dick Ehst, who is the President, Chief Operating Officer, and Chief Lending Officer at Customers Bank. David Bagatelle, who is the Executive Vice President and President of the New York Metro Market for Sterling National Bank. Matt Petrula, who is the Senior Group Manager at M&T Bank. And last but not least, he is a bank also. It is Matt Galligan, who's the president of CIT Real Estate Finance, which is part of CIT Bank and One West when they acquire of it. Even though Sterling has been around probably since the late 40s or the early 50s, originally starting as a factor, it's a new Sterling. So you are a new entry into the market. And Dick, nobody's going to understand, but you're in Wyomissing, Pennsylvania. We need a map, a Google map to go to Wyomissing over here. So you're like the new entrance, and Matt over here is really another new entrant in certain ways because CIT was in the business. They're really known as a factor, but they've been very involved since Matt joined them 3 years ago to be a new entrant. And Matt, sorry, Mr. Petrula, you're out there.
Veteran.
You're the veteran. How do you see the market? I mean, and why do you come to the streets of where they're paved with gold? Because, Providence, they didn't know anything. They were in Montebello, New York. I mean, it's nearly as strange as Wyomissing.
I think what attracts all of us to this market is the size of the market, the strength of the market. New York is unlike any other market in the country. And for that reason, I think we've got, and I think New York has a bright future, in spite of varying opinions on the new political landscape. But I think we've done a little over $2 billion worth of business here in the last 26 months, and we've got strong pipes. Asset quality is outstanding.
But don't you have a lot of competition with the guys over here, especially the veteran over here? He has money, they have money. Everybody's looking for the same pound. They're all looking for the same market. You are really after the same market.
I think to add on to what Dick said and also what you said, there are 56 million tourists that come through here. They spend over $50 billion. So this economy is as broad-based as you can imagine. People would tell you that it was driven by the financial services industry. Well, today that's about 25% of the overall economy. Another 25% is media, communications, and entertainment, which I find just astounding. We've now taken second place behind Silicon Valley for high tech, and that's ahead of Boston, which people thought was the center of high tech. So you have the hospitals here that are some of the best hospitals in the world. Why wouldn't you live in New York?
It's expensive. That's we were talking a show that I recently did about the high prices of condominiums that who can afford to. I mean, it's a rather prohibitive expense. I mean, you're into construction, and both of you are into construction of certain rentals and condos, but not everybody can afford these type of rents. How have you looked at the market? Because you were in the market even when the recession wasn't in 2008. How do you see the market?
We were. We're bullish on the market. New York is such an international city. There's something like condos specifically. There's something 4,000 or 5,000 condominium units listed in Manhattan right now. It's a city of overall 7 or 8 million people. So the barriers to entry are still very high. Will continue to be very high, we're attracting capital from around the world, and the pricing seems to hold up really well.
We were talking about this in the green room. Bank of the Ozarks, okay? You're not from the Ozarks, but the Bank of the Ozarks is buying a regional bank over here. Fifth and Third has opened up a location. SunTrust Bank has come to the market. So you have East West Bank, these other Asian banks and other categories. They're all coming to the market, and they're looking at the market, and they're chipping away at everyone else. So this is having an effect on your profitability because it's additional competition. It's not that, Sterling once had a factor, okay? But, when you're looking at the real estate market, there's different aspects of the market.
But don't forget how many of the Germans have left the market. Right. I don't mean to suggest that there aren't new.
I believe you used to be with the Irish too.
The Irish have left the market, that's right. Every Irish bank has left the real estate market. So the Europeans have contracted very significantly. And one of the phenomena that we have here in New York is the deals are so large that if you get a $150 million deal or $200 million deal, you have to underwrite it to the lowest common denominator, meaning the most conservative dollar. So on the larger transactions, there's a lot of equity in them. They have to be structured right in order to get those sold down. And I think the true people at risk here, if interest rates went up, wouldn't be the banks, it'd be the mezzanine lenders, and they're just all over the place.
So what's the new Sterling doing, David?
So
and how do you look at the market?
Well, I mean, Sterling, as you know, we merged with Provident Bank, who is a Hudson Valley-based institution, and everybody looks at us as sort of being new in the New York environment, but the reality is the bank may be new, but the people aren't. So we've gone out and hired very experienced people here in the marketplace. So yes, we're new in terms of certain areas, but the people that we've hired have a lot of experience. To build on what Matt was saying, yeah, there are a lot of new entrants, certainly, but there are a lot of people that have exited the market. And frankly, some of those new entrants, if they don't hire the right people or do the right sorts of things from an underwriting perspective, a pricing perspective, they're going to soon exit the market as well.
As I was saying prior to the show, there is a frothiness, and what happens is it's like an association of real estate developers. They hear that there are new players in the market, and they say there are new players, and they unfortunately they pit you against each other on the pricing. how do you protect the risk of a bank being a relatively new bank? I mean, but you've been in the banking business for your entire 45 years of career. How do you protect yourself that you're not, even though Matt said, you know, underwriting, it's the mezz lenders, sometimes, you know, real estate taxes go up, insurance goes up. We have another blip like 2008. Even in the multifamily apartments in the Bronx, people aren't paying for. How do you protect your risks? Because we're writing, you know, when somebody says to me a loan to value, it's a question of what value is that.
I think the opportunity that all of us have, because this is the multifamily market especially, is not necessarily driven entirely on price. Price is very important. You know, terms and conditions are important. But it's the speed with which you can execute that becomes your defining difference. And I think we protect our risk by maintaining, I think we've got exceptional underwriting standards, and you never compromise your underwriting standards. Not like the industry, which every 10 years needs a lobotomy. So you maintain your credit standards, but you execute flawlessly on the delivery of the product.
I think it is, you've got to maintain discipline here because there are clearly some irrational players in the market doing things that, from a pricing, from a covenant standard, from an LTV standard, that just don't make sense. And unfortunately, where I think we are headed is for lobotomy. Again, I see some of the things that some of our competitors are doing, shall remain nameless here in this discussion, and I scratch my head. It doesn't make any sense.
You know, I was talking last week about a phenomena of hotels. The hospitality market is doing great in New York City. Occupancy is at record levels. Rates are pretty close to record highs. And right now, 2 brand new hotels who have no experience have recently have sold in excess of a price of close to $2 million a key. In order to sell a property at $2 million a key, the Park Hyatt just sold for $1.9 million a key, and the Baccarat is going to go for over $2 million, and then the Four Seasons downtown. To go for that type of number, you need a room rate of probably $1,400 a night. Now, there are wealthy people, but there aren't that many wealthy people in that market. But this entire hospitality spectrum, because there are no more parking lots in New York City, and you guys have an exposure in that. I mean, I don't believe you really have an exposure in the hotel world.
We have about 15% of our portfolio, one construction loan. But I think if you looked at the portfolio, it's not representative of what's going on in New York. To your point, Spitzer announced, or it was announced yesterday in one of the rags, I think the real deal, that Spitzer's building a hotel over on West 35th Street. Sam Chang is going to build a $600 million hotel over there. He's got limited services hotels in that neighborhood. So if you look at the West 30s, I don't think you could go through a block where you didn't have hotels.
You have approximately, on the, people call that Times Square South. I don't understand why, but there are close to 55 hotels within a short period from 35th Street to 42nd Street, between that market. All the previously, loft buildings that were over there in the Garment Center, which is no longer the Garment Center, have become hotels. I mean, have you gone into hotel finance?
Modestly. We look at boutiques that have a long history of good management, and but we're looking at total deals of no more than $10 to $15 million each.
Yeah, hotel hospitality is a business, a large business for us, but relative to the size of our portfolio, it's not even quite that significant. It's under 10% of our book. It's been a really healthy asset class for us. But doing business with the right people, having their own equity, and people who know the market, who who we know well, is so important to our business model, and it's served us well. And our exposure is, needless to say, is nowhere near the levels that you're speaking about. As far as I imagine, those deals will go off with a lot of equity when they get financed.
What about Sterling? Have you been in the hotel finance?
Done a small amount. We were going to do a deal together, in fact. So on a refi that we had originally done a small construction loan on. So we've done a little bit, but I agree with Matt. It all comes down to the people. It's a character issue. Who are doing business with the right people.
Another area today, which is, and one of my guys was saying on the prior show, many properties were built with non-union trades, and now the union's getting stronger again, and the cost of construction is going up. And I don't believe you're in the construction business. You're in it slightly, you're in it heavily, and you're in it relatively high because you can get a higher risk-reward situation. How do you look at the construction market because of material prices going up, labor costs going up, and limited guarantees by the developer? Matt?
Well, I mean, you'd have to be concerned about the cost of construction. If we were leaving 42nd Street, going down 7th Avenue, the number of scaffoldings on buildings and cranes and that sort of thing. You go down to World Financial Center, that area as well. There's just so much going on. I am actually very surprised that there hasn't been a lot more upward pressure on prices. So we're concerned about that. We have a deal, as you know, in Jersey City where there was a significant cost overrun before we started. So it is seeping into the marketplace. Our view of the guarantees is, on a construction loan, we want a debt service guarantee and a completion guarantee and a bad boy guarantee. We are non-recourse. Philosophically, we think we're trading recourse for a couple extra dollars in the deal. And, we want the property. We don't want to have to go through the New York judicial process to get a hold of it.
How do people look at, let's leave Manhattan centric because you're a Montebello-based bank, even though you're New York and Montebello, you're a Wyomissing, Pennsylvania. How do you look at the suburbs how do you look at Jersey City, Westchester, and Long Island today?
We're a very diverse bank. We only about 40% of our outstanding loans are in commercial real estate. As you know, we're very strong on the C&I front, mostly from the legacy Sterling, from the factoring and the asset-based business. So Long Island and New Jersey, very robust C&I markets, very strong. You're seeing home prices starting to come back in those areas. The economies in those areas are strong, and there's an opportunity to do a lot of business there. And the competition is a lot different. Certainly you have the mega banks are in those places, but kind of the next notch down, it's a different collection of players that you're.
I mean, an excellent example is what M&T. There is the potential acquisition of Hudson City, but M&T went to New Jersey about a year and a half ago and has made a really major presence, and people know about M&T today. Mm-hmm. They've really done a good job over there. How's your involvement in Jersey and Westchester, and have you looked at Long Island?
Westchester's been very strong for us. We have a significant presence in Rye right now. And we go over into Fairfield County, into Connecticut as well. Jersey City I like. I believe me, I've had my eyes open about Jersey City. Long Island, we just hired the national director of SBA lending out of City, and he joined us 2 weeks ago. He's going to be based in Melville, so not that that's a direct relationship to how we like Long Island, but we do like Long Island a lot.
Well, what about different aspects of the market? We know that everybody likes the multifamily. There's a question, the office market today, I think David would be shocked to hear that the building that he's in, a couple of years ago you could pay rent at $30 a square foot. I have a friend who's a law firm today is looking in the neighborhood and they're talking about $60 a square foot. I mean, the pricing has increased. How do you look at the office market, hospitality we've already discussed, the retail market and the boroughs, okay? What's your thought? People say there's not much going on in Staten Island and the Bronx because of the commuting over there. But today is the opening of the largest enclosed mall in the city of New York, in the Bronx. It's not near transportation, but it's good parking. How do you look at those different aspects, Matt?
You hit it right on the head with respect to transportation. The linkages are so key, right? And all the places, if you look at what's developing in outside of Manhattan in Long Island City, it's well located. It's 2 stops from Midtown, Williamsburg and the whole tech triangle, the connectivity to downtown Brooklyn, to Williamsburg, to Brooklyn Heights, all terrific. I think that's key, and that's what we look for. Is a location where maybe it's still on the come, but it has strong linkages, good drivers, and obviously sponsorship is important.
I mean, talking about multifamily, obviously from an asset class standpoint, we like it as collateral, but from a return standpoint, the returns just aren't there. So from a risk-reward standpoint, we actually are doing quite a bit of mixed use, quite a bit of retail, quite a bit of office, so we are looking at alternative asset classes. You can get the return, you can add value.
But you see what Matt brought up, which is something that I've been harping on, and I did a show a couple of months ago on transit-oriented developments in New Jersey, is that if you have transportation nearby, like Morristown, Jersey City, or light rail, that's a big situation. I mean, that's what helps. It's helped in Pennsylvania also.
Absolutely.
And I think that's a very important thing. But we don't have enough land in Manhattan, so we have to be able to develop other places. So the question is it the Bronx, okay? Westchester, you may be in Rye, but the office market in Westchester has never gone up in 25 years. It's still the same rent. No, and there's discussions, and I know that Matt Calley is one of them, who are planning to take their office buildings and trying to convert them to residential.
Right.
Right.
Well, they've gotten out of some of the residential markets. I mean, our building in Montebello, for example, they just recently sold. So,
But they are going the adaptive reuse way, and actually, we've seen a lot of that. On Wall Street, we've just done a deal in an office building that has excellent light, beautiful views, and it wouldn't be obvious until you walked through it that would be what that building could be adapted to. I was downtown earlier this week at night, and I looked at another building that we're considering, and it makes sense. It's got views of the East River and a lot of light. And while you're walking around downtown, you're going to get run over at 8 o'clock by some man or woman, under 30 years old running. This is where they live, this is where they play, and there is still a little bit of discount there relative to the other areas of Manhattan, and great transportation.
Yeah, the amenities are still sort of on the come there, but there's tremendous things going on downtown, and some of those old buildings with the ceiling heights and all the wedding cake designs were very conducive to conversion.
Downtown there was a lot done downtown in the mid-90s because the city basically gave these 421G credits of a 20-year tax abatement, a full tax abatement. There aren't tax credits, there aren't abatements, and as people would say, we're in a new administration and we haven't seen the batter up yet. We see he has his bat. The question is how the bat's going to go, where the swing would be. So that's a question over here. And then you have another situation. There's a dynamic mayor in Jersey City by the name of Steve Fulop, and Steve Fulop wants to get people, and he's giving incentives. He's offering people tax incentives if you're a certain distance away from the train or so on, to help the community, and that's a big difference to help the economy, and also when you're looking at real estate or other.
He also comes out of a business background, including Goldman Sachs. So I mean, he knows what needs to be done to get things done.
Exactly, Matt.
New Jersey. We talk about Jersey City, we speak about Hoboken. One of the cities that really has not, even though it has one of the largest airports in the city, in the area, is Newark. It hasn't done well. It continues not to really do well. As a bank, have you looked, I mean, bank or financing to do anything in Newark?
We're looking at one transaction right now. Just one.
We have clients there in the city, as we have clients in Patterson and Jersey City and Passaic and a lot of the other major municipalities in New Jersey. But you know, it's been challenging historically there because of some of the political
No,
issues.
political issues and the crime issue has always been a major distance. I mean, Harrison, you know, has had certain markets doing well, but as I brought up before, you know, Morristown has done well, and parts of Bergen County have done well. So it's a different market. What about Long Island? I mean, you know, because there's two different. You know, the biggest problem that most people see about Nassau County is that the real estate taxes are really high. At times they could be higher than the rent for the building. Suffolk County is a different situation. I mean, what's the bank's exposure and involvement out in Suffolk County?
So we have also have a lending team based in Melville, and they're doing some nice business. It's a tougher market because you really do need to, in a similar way, suburban office, right? As you said about Westchester, is rents tend to not move very quickly. Turnover is always is an issue. When you lose a tenant, it takes a lot longer to fill it. Your TI and LC costs are not that different than the city, and when taxes are going up and they're $7 or $8 a foot, it makes it difficult to rent space at $26.
Well, one of the largest segments I think that Matt brought up before, you know, we were talking about healthcare is key in New York City. You know, it's people come from around the world to go to healthcare, and one of the new phenomenons is the urgent care centers. Have your banks or institutions looked at that or other aspects of healthcare?
We like them a lot. They'll make a difference in the delivery of health care. Absolutely.
Matt?
We haven't. Personally, I look at the deal that NYU did, where they bought the Verizon structure.
Right, but
between second and third.
that's a day surgery center. The urgent care centers are, I've done some shows on that, is a true segment of where you don't need to go to the emergency room, and if you go to the emergency room, you're going to spend $500 as your deductible. If you go here, and the ones which are staffed by physicians as opposed to nurse practitioners, they're providing pretty good services. And if they believe that the condition requires more care, they will then send you to a specialist or to the emergency department. So it has a big market. I know you guys have done health.
We have. You know, we like the healthcare segment. It's a significant part of our business, and I think looking kind of in the crystal ball, we'd like to make it a bigger part of our business. We like surgical centers as well, obviously assisted living. We like a lot. Done a
Why,
lot.
you think of going there?
Well, someday we're all going to go there, right, Michael?
But
I hate to tell you, but
But I'd like to say I think that as I start my 14th season, I'm really happy that I've had the four of you to provide your thoughts and insight about the banking environment and the marketplace, what's going on, and how you see it. And I'd like to thank Dick Ehst, Dave Bagatelle, Matt Petrula, and Matt Galligan, and I'll see you next week.